Have you been seeing red in your 401k? Well, you're not alone. The S&P 500 is down about 8 to 9% year to date. 2022 hasn't been pretty so far, and it is possible you could see even worse returns in the months to come. But before you do anything drastic, let's just remember why we invest in the stock market to begin with. Back in the early 1900s, companies used to be privately held, oftentimes by one person or one family with just enormous wealth. Think of the Carnegies, Vanderbilts, Rockefeller. That all changed with the advent of Wall Street and stock exchanges. Companies that want to grow need money to invest, and they can get that money one of two ways. They can go to a bank for a loan, or they can sell shares of their company to raise capital. Today, publicly traded companies are listed on an exchange and they sell shares of their company to the public. And then everyday investors like you and I trade shares back and forth with each other. The goal, of course, being that eventually you will sell your shares for more than you paid for them. The stock market is an opportunity for everyday people to invest in companies of all sorts and sizes and take part in the overall expansion of the economy. Again, you used to have to be super wealthy or start a company from scratch to really participate in general prosperity. But with the stock market, and more specifically a 401k, where you can save straight from your paycheck, we can all now easily and more cheaply become investors. In fact, super concentrated wealth now is abnormal. Think about the headlines of Elon Musk buying Twitter. It's now weird that this bazillionaire is purchasing an entire company and taking it from public to private. But I digress. What we need to know about investing in the stock market or in your 401k is that it can be volatile, and the value of your account will go up during certain periods of time and down during other periods of time. The market is bumpy when there is uncertainty, and right now there's a lot of uncertainty. We have a war, we have the Fed raising interest rates, and inflation that is just flat out scary. We actually have an index that tracks this volatility called the Fear Index. The ticker symbol is VIX, and this index monitors option trading and can be viewed as an indicator of what those large market investors are thinking. I know the volatility seems very high right now, but relative to 2009 and 2020, the VIX index isn't looking all that bad. And while 2022 market returns don't look and feel good, remember that what you are seeing on your app or on the TV at night is recent returns and sometimes just what happened that day. Long-term investors, don't let yourself get distracted by daily or even quarterly returns. They're gonna be all over the place. Start tracking your long-term returns. Since its inception in 1926, all the way through the end of last year, the S&P had an average annual return of 10.5%. In fact, pick any 20-year time horizon in the stock market, the worst one you can think of. From its inception, if an investor stayed in the market for at least 20 years, no matter which 20-year period you picked, the absolute worst they would have done is 6.4% per year. And that time frame was actually in the 60s and 70s. So here's my point. The stock market is red, and yes, it can get worse. It's a fickle thing that literally reacts every second to news headlines. Over a 50-year time frame of investing, you could experience on average 14 bear markets. Bear means bad market. So be aware of them, but keep them in perspective. The S&P 500 is still up more than 9% from January of 2021, and it is 30% higher than it was in January of 2020. Investing in the stock market and through your 401k is the easiest way for you to participate in the American dream. No, we don't all have $44 billion to go buy Twitter. But each and every paycheck, we can buy little bits of companies here in the US and all over the world. And over time, we too can build wealth and prosperity. That's it for this week. This is Jeannie, the 401k lady.